Wednesday, everyone. I hope you are all safe and sound at your homes while we're staying at home at these days. And welcome to the first episode of FinTech Istanbul's Digital Meetup series. Since we are locked up at our home, we have decided to bring our meetups to your home. Hope you'll enjoy the show. Today, I'm excited to be with Paolo Sironi. He's one of the most respected voices of FinTech, as you know. I've been with Paolo in a couple of occasions in Istanbul, sharing the same stage. But now we'll be sharing the same screen with him. I think this will be the new normal these days. I'll start with a short introduction about Paolo. I'm not sure if he needs some, but for the ones who doesn't know him well, he's an author. For my favorite, FinTech innovation is my favorite. He's a global speaker also, influencer about innovation and technology in financial technology, and the FinTech voice of IBM also. And he's also a lecturer, as I know, in some of the universities. And I'm sure this is a short list. Maybe you can find his bio on the web. I know that he's interested in risk management and the theory of behind it. Today we're going to talk about the current issues created by COVID-19 and their effects on FinTech industry and transparency in financial markets. Then we're going to combine fundamental uncertainty theory in economics to open banking platforms and maybe some new business models for banks in the era of post COVID-19. Now I'm going to leave the stage to Paolo. He's going to start with the presentation, and I'll have some questions to him. Yes, Paolo.
So thank you, Selim. Thank you, Meta. I'm very happy to be with FinTech Istanbul today and your fabulous audience. So we spent half an hour discussing the concept of transparency versus uncertainty, driving and taking some lessons learned from the outbreak of COVID-19 and how variety of institutions try to respond to this compelling problem. So basically, the message that I want to share with you today, which will be relevant when we discuss the platform theory, are the following. We need to learn how to. Okay. I stand.
Can you hear me well?
I do.
Okay.
Do you want me to wear handcuffs?
I mute myself now.
Yes. Okay, so I said that I have 3 lessons learned from the COVID-19 that can inspire or reinforce some of the messages we shared in the past about FinTech innovation and the platformization of banking and finance. The first message is about transparency. We shall embrace transparency inside ecosystems, economies, and digital platforms, because without transparency, complex systems don't work. Second, we need to promote openness about the future, because we don't own the future. And also about data ownership. If we're not open with the data, we cannot unlock new value that otherwise would not be generated. And this new value is relevant to make sure that our complex ecosystems can thrive and survive. And third, we need to create awareness in users, in people, in banking clients by building advisory relationship with the usage of digital technology and artificial intelligence. So all of these, which is my common topic, will be discussed today, starting from a review of what is going on given the outbreak of the coronavirus. Why does this matter to me? Because I do believe that digital is not a complex innovation per se. I think that the most complex innovation is to change the way we believe the world works, so finance. That's why we need the proper theory to guide our decision making and our entrepreneurship to make sure that we don't simply make change, progress. So we have 4 little stories to share in the first half of this seminar before we go to a question and answer with Salim. First of all, we need to recognize that uncertainty is the new normal. Second, once we know that, we need to look for new micro foundations for banking and finance, which are biological, so that they link to the human being instead of looking at the abstract concept of data or the mathematical natures of financial equations. We can therefore derive a practical theory based on the concept of financial market transparency, which is practical because it enables us to build a business model for banks, for central banks, for regulators, using technology that is effectively human-centric, which is the last of the 4 little stories. So we jump straight into the first one, which is the one that concerns all of us these days, given the coronavirus outbreak and the amount of uncertainty which has been brought into our life, into the economy, the way we work and collaborate with family and colleagues. It was already confusion in the banking system. This is my banking comics. I don't know if you know Oliver and Hardy. That was almost 8 years ago comics in the US. And Oliver is the fat guy laying on the bed, is the sick, the patient, is the bank. And the central bank came to rescue him in 2008 at the height of the global financial crisis, imposing some new rules, which, by the way, put a cast on his leg. So the bank cannot do as much as was capable of doing before. The FinTech are like Hardy, they try to pull him, right? So they want him to move, but of course he can't. Also because you see at the bottom, the legacy systems, they're bringing him down to the floor. It's a very heavy infrastructure. And the regulator, which is the nurse at the back, comes from time to time to check if the bank is doing what the central bank was asked him to do, so what the regulator were asking. Now, there is too much confusion, and this confusion cannot be resolved by one actor only. It requires a co-petition, so the possibility of the whole ecosystem to transform into change. Some need to make a step ahead, others a step on the side or a step back to make sure that we transform financial systems. Now, I don't know if you remember Mario Draghi in 2019. This little clip I want to share with you was filmed 1 week before he left office and was basically substituted at the end of his tenure by Ms. Lagarde. Let's listen to what Mario Draghi said about the status of banks and the impact of digital.
The necessity to adjust the business model to the digitalization, to the changes in technology, is something much more compelling than being angry about negative rates.
So basically, there is a need of changing the business model irrespective of the economic variables that are being created by the ECB, because digital is also requiring us to operate in a different way. And we need to understand how to do this. The problem is that not many people discuss what the business model might look like, which is instead the core of our presentation today. Now, all of this is happening in a time which is really unprecedented. In September 2019, the European Parliament asked the Econ Committee to write an economic paper that was published in 2019 September to address the change of guard between Mario Draghi and Ms. Lagarde. In this paper, okay, so there's anything I have to do for you to see? Yes. Like this? Okay. Good. So this is the paper of the Econ Committee, I said, and this economists in September last year, before the coronavirus outbreak started, already identified one key element that the European Central Bank had to consider in the coming years as the core of the monetary policy making. Of course, there were three pillars. The first one was the balance sheet is too large, maybe there's not enough space for cutting interest rates. That means if there's a new crisis, we have a problem to use. We have a problem to use. The second monetary union. The second monetary union. Europe is incomplete from the banking perspective, and therefore there cannot be proper coordination between monetary policies. But the third one is very important. Because the European Parliament was already discussing the fact that there is a lack of understanding at the ECB level of a new economic normal that some characterize as fundamental uncertainty, which is the core of my forte of my literature. It is the nature of fundamental uncertainty, they say, that it is not measurable. So that means we cannot use the way of thinking we did before in order to resolve it. But they say in internal deliberations, the ECB staff will present the new president, Ms. Lagarde, with a number of arguments that will point in the direction that we are indeed operating in an environment of fundamental uncertainty. So you see, even before all of this started, fundamental uncertainty was at the top of the agenda of the European Parliament, addressing the ECB at the highest level for a new way of looking at the banking infrastructure and policy making. Now, I had the chance of sharing my book, The Financial Market Transparency, with Ms. Lagarde in Mexico last year. I don't know whether she had the chance of reading it. For sure, she read the one of the Econ Committee. And this is fundamental to me because even the Kristalina Georgieva, the new chairwoman of the IMF, replacing Ms. Lagarde when she went to the ECB, has been publicly discussing about the fact that we are going to live more and more into an uncertain historical period. We listen to this short interview on the CNN.
Uncertainty is the new normal, and therefore we have to help our membership to be more agile, more adaptable to this fast-changing world.
Now, this was taken in December last year. Nobody was expecting uncertainty to take the form of the coronavirus. I think that many might have thought about the Brexit, the Gilets jaunes, the environmental problem, the lack of inclusion, the trade war, so the tensions geopolitically between East and West. But something happened instead. So a virus that many thought was exogenous, that means it was in China, was not in Europe, instead came to Europe. And the Americans thought, oh, it's a European or an Italian thing, it's not for Americans. And now it is unfortunately working everywhere in the world, even in Manhattan, affecting capital markets and the banking infrastructure. Now, let's go back to this one. I want you to watch this video in 2005. So this is former President George Bush that was talking to the National Institute of Health in the United States in 2005, a couple of years after the outbreak of the SARS. And basically, he was already identifying, and these are the key words that you see below, the elements of the coronavirus outbreak that we were living today, because the World Health Organization, the World Health Organization was basically discussing the possibility that this type of uncertainty could be realized. And I want you to listen to what he said under the guidance of the WHO about the possible response to a pandemic event.
The pandemic is unlike other natural disasters. Outbreaks can happen simultaneously in hundreds or even thousands of locations at the same time. And unlike storms or floods, which strike in an instant and then recede, a pandemic can continue spreading destruction in repeated ways.
Okay, so I do the following. I tell you what the speakers say so that you know what they say. Do you do it this way? Or we get into a conversation mode? Okay. So basically, George W. Bush, the former president of the United States, in 2005 said that there is not a pandemic issue today, but there might be a pandemic problem in the future, and we need to start addressing it now because otherwise it will be too late. So that was 2005, and it was describing exactly what would have happened, and that happened because we live it every day. So that is said that in order to resolve this problem, we need to have three basically course of action. First of all, we need to start planning. Okay, we cannot wait. We need to do it now, even though the problem might be late in the future. So that's a problem of thinking about transformation today for something that might have its effects in the future and not in the immediate future. Second, we need to be very transparent with data and with people because we need to create what I would say consequential statistics. So invite the population to change their behavior because they need to self-protect and protect the weakest link. And that only creates a responsibility so that all actors would collaborate in order to resolve this problem. Now, this is 15 years ago, was basically forgotten. But when we see what happens today, we basically see that the governments are responding in a variety of different ways. One way is basically to lock down a full economy because you don't have an alternative, which creates a further collapse of the system. Another one instead is to apply the concept of transparency, openness, and ongoing advice in order to make sure that we remediate the problem without having a collapse of the system. And this is basically the message of the Minister of Foreign Affairs of South Korea. South Korea was one of the first countries to flatten the curve for the outbreak of the coronavirus. And in an interview on the CNBC a few weeks ago, the Ministry of Foreign Affairs of South Korea said that this was possible because the action was based on three elements: transparency, openness, and ongoing advice. So she said, as we've been very transparent with the citizens, so all of the agents of this economic and social platform, they could change their behavior. So they understood why they had basically to self-protect, to stay home, to sustain a cost. Second, we had to be open in two elements: open about the future. She said we didn't know much about the coronavirus, but then open with the data. So basically it's like putting the data on a platform where government could share with the health organization, could share with the private sector, everybody collaborate in a competition way in order to create a solution for the problem. And then third, she said, we're going back continuously to our citizens, creating ongoing advice. That's also important because you need to create some feedback loops, and that's like the action we will see later on of a bank that needs to go back to its clients continuously. It's not just about selling an idea or a request. It's about creating a relationship and engagement through a good experience that enables to reinforce the concept of a certain behavior. So then, this is what happened in the coronavirus crisis. And as you heard, the key words that these people used to address it before and to resolve it after were openness, transparency, and ongoing advice. And this is actually the core of my fourth book of my FinTech literature, which is the Financial Market Transparency, which promotes a different way of looking at finance to create a business model that basically is capable of aggregating a new relationship which is more sustainable and fair between financial institutions and their clients, so that the whole system becomes more anti-fragile. That means it's capable of sustaining uncertainty. Because I was discussing with the ECB for the presentation of this book last year, when uncertainty comes, the system, which is too rigid, might not be capable of coping with that. So risks of collapsing again. And if we want to avoid that collapses, we will have to spend so much money that might become effectively unaffordable. And we're seeing it today, given the discussion of the helicopter money, the intervention of the Fed, the ECB, the Bank of Japan. Now, the two macro foundations of the financial market transparency theory, which also matter for digital action, are these two: fundamental uncertainty and the reversibility of time. Basically, fundamental uncertainty means that when we came to this world, we were very weak because we were babies, and then we grow and things happen in our life. We have goals, we have scope, but there can also be elderly days, there can be a risk like a volcano exploding. So basically, we don't know what happens. So as a human being, we're typically wired in order to deal with the concept of uncertainty, even though we might have forgotten that, because in the Western world, the standard of living is pretty high. But in the 1990s, Paul Krugman, Nobel Prize for Economics, was mentioning that America was not a meritocracy anymore, because the probability, the possibility of children of American families to make more money than their parents were diminished. And he said, as people will realize that, they might create instability, anxiety that we saw as a reflection of this element, because we know that America is not inclusive any longer. We can call it Brexit, we can call it the sovereignism or the Gilets jaunes. At the same time, we also need to have the concept of time, because time is the way, and I don't have much time to discuss today with you, but is the way we make an interpretation of reality. So time is where we position goals, when basically we are capable of stretching into the future, looking at what might happen in the next years. You remember, we will see the result, not in this quarter, not in this year, but maybe into the future. So we need to train the economic system with uncertainty and time, the concept of finance and digital innovation. Well, we start from the human being. I said that our consciousness is born because of our relationship with uncertainty, that means we have to survive, and time, that means we need purpose in life. We cannot enable us to understand the concept of our human survival in life, coronavirus, and the purpose in life. Now, what is finance? Many people misunderstand finance. They talk about risk, return, interest rate. Not really. Finance is nothing but trading uncertainty over time. That means our money needs to survive when we invest, and we know that we need to invest with purpose. We need to take care of the environment, the global portfolio theory. So if you studied Markowitz, modern portfolio theory, you know that there are two main limitations in the theory. The theory is based upon the idea of optimizing a portfolio, an investment strategy, on an efficient frontier. Now, on the efficient frontier, you don't have uncertainty, because the whole discussion is based upon the data you have, but the data does not contain the future. So that's why you can never reach the optimization, because every time you try to do that, the situation has changed and the optimization doesn't work anymore. And second, the theory is atemporal, because it doesn't enable people to make decisions for the short, for the medium, and for the long without changing the assumptions. So it's not suited to describe what we really need to do as human beings. Therefore, we need to find a way to recuperate the concept of fundamental uncertainty and the irreversibility of time to create a new theory that enables us to transform the business model of banks, because the value of the bank is at the highest. Because there is a big debate about AI being capable of replacing human and driving the world, and therefore the concept of ethics of AI. Now, I want to tell you this. What we see today typically is narrow AI. It is definitely not general AI. The difference is that narrow AI applies to a little problem. The human being applies to many problems, okay? And is not capable of self-explaining the decisions that the algorithm made. Now, in order to transform AI from narrow to general, two things need to happen. First of all, the algorithm needs to bring uncertainty from exogenous to endogenous, because it's not part of the big data set. And you cannot just say, I have to stop everything and recalibrate the model that drives the cars around Singapore because now I have new data. No, you need to make sure that the algorithm is like biological algorithm. So again, you see, the researchers that are researching very deep into AI to make AI from narrow to general are really looking at the macro foundations of the FMT. First of all, the concept of uncertainty to bring it inside the big data set. And the second is the concept of time, because time creates a synchronization between people and individuals. So only if the algorithm would have a concept of time would be really ethical. So far, we primarily talk about bias and unbiased, which is the ethics of the programmer. It's not yet, for me, the ethics of the algorithm, because the algorithm can become ethical itself if he has a sense of purpose, therefore can develop his goals through time, having the sense of life and the sense of death. So now this is super important, because exactly these two elements, the a relationship of human beings with fundamental uncertainty and the irreversibility of time make money emotional, not rational, which is where many fintech entrepreneurs made a mistake. You know, clearly banking and finance is a very asymmetrical industry. But this asymmetry of information that shapes the revenues of banking and finance is not about information. You can provide as much as information you want to people. The asymmetry will stay there. And the fact is that this asymmetry is biological, again, because it's related to the way we can deal with uncertainty in playing with money, survival, and purpose with respect to other problems in life. So if you put on a line all of the banking business units, the line is the intensity of the asymmetry of information. The left is less intense, the right is more intense. You immediately see what is easier to digitize and what is more complex to digitize. Because payment is very easy to digitize, because it's pull. Pull means you know your motivation when you pay something, right? You're buying something, so you pay for that. That's why most of the fintech started from the payment mechanism. Borrowing is already more asymmetrical, because you understand the value of borrowing, but you may not be capable of plugging properly inside your financial planning. Now, if I tell you go to the Apple Store and download my Paolo Sironi app, click on it, I will give you 1,000 euros for free, zero interest rates, zero commissions. Give it back to me anytime you want. I bet that many people listening to this seminar today will just do it to get the money. You will be happy, but I will have a huge risk management problem. So you cannot just trade this motivational element to pull borrowing like that. You need to do basically more. But if you move to the right side to investing, like the robo-advisors, you see that the amount of asymmetry of information grows. If I tell you, go to the Apple Store, download the app, and give me 1,000 euros that I will invest into a Markowitz portfolio that has been optimized on a long time series, taking into consideration correlations and volatilities, many people would, frown because they don't understand what I'm talking about. And that's the reason why robo-advisors were not that successful, and they required to be plugged inside the hybrid models, because the asymmetry of information was higher, because the amount of uncertainty is higher, because now I'm putting the money outside my bank account, and my brain is telling me, look, there's fundamental uncertainty. You might not survive, your money might not survive. So there's something that you need to consider, but you don't have the tools to consider that. And then insurance, which is a very interesting industry, but has been slower to catch up the fintech and insurtech momentum, is the most asymmetrical industry of all. Because for inviting people to buy insurance for life events, you really need to tell people they have to die. So without a proper conversation, every insurer agent knows that it's very difficult to position this structure. So that you see these contracts, you see that going to the biological micro foundations of finance, uncertainty and time, enable us to understand where is the real problem of digitizing a banking relationship, because if we can give an answer to these biological micro foundations, we know that we can be successful. Otherwise, we may have some clients joining in because it's a good user experience, but nobody will be active, so we will not generate revenues. So that brings us into the concept of the business model, right? Because we now know that human beings have a special relationship in their consciousness with fundamental uncertainty and the concept of time, so survival and purpose. We know that finance in general is about survival of investment of our enterprise, of our startup, and purpose, because we want to do it with purpose and responsibility. And we know that all these two elements explain in their intensity the capability that we have to self-direct or not on a digital platform, instead of looking for a relationship, which is the mechanism why that typically people use in order to make financial decisions. Now, notwithstanding, we know that banking is facing a deep crisis that started in 2008, and unfortunately the coronavirus, on top of the humanitarian problem, is creating a new financial problem. Margins are squeezed to the limit. That's what I had this morning for breakfast, a freshly squeezed orange juice made of banking margins. The interest rates are lowered across the board. We saw the US going to zero, and possibly they will go to negative territory as well. The cost of capital was unprecedentedly high. And that forced banks to move from interest rate margin, giving money to the economy, to intermediation margin, which means payment, which are getting disintermediated by the big tech, and wealth management, that is investment management and insurance that we saw before, are very asymmetrical. So they're very difficult to digitize. Now, when this all started, when in 2008 the financial crisis started, that was a moment of revelation, because people like Alan Greenspan, the chairman of the Federal Reserve, clearly stated that we were at an inflection point. So the models, the way of thinking, remember the Econ Committee paper that we used so far, was not capable anymore of enabling us to manage the future. So there were 4 types of responses to this, and I want to focus on 2. One is the central bank. We just mentioned that, so the unconventional monetary policies, we will see in a moment with the central bank digital currencies. Behavioral science trying to say is not the reality, is the individual which is faulted. Let's change the individual with the nudges, and we go back to the previous theory. It is not possible. Transparency regulation, which is part of the topic today. In Europe, that was the MiFID II. Even open banking is a regulation about transparency, so making data accessible transparently to third party to create new value. And then digital innovation. But I focus to these 2 elements, so the concomitant action of central bank intervention and the digital transformation to affect the business model of banks. So Ms. Georgieva said that we are into new normal. That is not just uncertainty per se, it's the fact that the central bank has created a new normal with negative interest rate. So this is forcing banks not to be anymore efficient centers of money creation, the credit function. So the central banks gives money to the banks, and the banks cannot give money to the economy the way it is expected. So banks used to be mechanism of money creation, adding payments, investing, and insuring on the side, basically transactional models. In order to survive under the new central bank normal and unprecedented uncertainty, they need to become instead center of advisory competencies, where the liabilities of individuals, of small, medium enterprises, and you will see many, unfortunately, appearing these days due to the coronavirus, are the personalization element. The assets and the insurance contracts are all commoditized. So that force banks to create a new business model where the remuneration from client does not come from products, but needs to come from client fees, relationships. And that is very complex for banks because they need to conceive on digital not to be digital distribution channel of products whose margins are going to be zero anyway, but need to start learning how to digitize relationship to help people and small medium enterprise to face uncertainty, which is also raising, to make more reasonable and judicious financial decisions. Now, given the effect of the monetary policy and the level of uncertainty in the economy, which is going to be accelerated by the coronavirus crisis, we know that this is happening. Now, some central bankers have been openly discussing the fact that this is really creating a transformation of the essence and nature of banks that FinTech needs to understand in order to address it properly. Thomas Jordan, the chairman of the Swiss National Bank, in a speech in September last year, said that broad access to digital central bank money would call the existing two-tier banking system into question. Instead of being the banker to the banks, as it is today, he said, a central bank would be taking on the role played by the private sector. Basically said, we may have to open branches. When he said that last year, people were like thinking, oh, this is extreme thinking now. Now you see the discussion today. The Federal Reserve is now trying to give money directly to the economy because they cannot even work with banks to make their monetary policy effective. They even had to go to BlackRock, so to asset managers, in order to access the market. Not banks anymore, because banks, as JP Morgan has recognized, has a lot of liquidity, but cannot play the liquidity because otherwise the risk of defaulting, because they try to be stable at all costs, given the experience they had at the height of the global financial crisis. So now, as we understand this, we see what happens. The ocean of banking and finance is populated by sharks, which are the bankers and insurers. And believe me, I love them because I go scuba diving and I'm always excited when I can see a shark. And we also see the piranhas in this ocean, which are the FinTech. Now, I know piranhas are in sweet water, not in salted water, which puzzles bankers, but effectively this is happening. For a long time, people thought that this was the competing elements, the piranhas attacking the sharks, the fintech competing with the banks, but this is not true. The truth is that the real competition is going to be more and more against the big tech platforms. And we saw these days the power of these platforms to face the problem of the coronavirus. And we saw these days Vanguard striking a deal with Ant Financials to distributing financial products to the Chinese consumers. So the basically merging of big players with big tech that basically is going to transform completely the way small banks, medium banks are operating, and therefore the capability of small fintech to compete, not just against the banks, but against the big tech. Now that means that fintech innovation that can really transform banks to be more robust and more value added for clients, knowing that typically big tech are a bit commoditizing, and commodity is never good for somebody, personalization is better. The only way is to learn the difference between value and volume. So banks and fintech needs to understand how to generate value for clients, understanding the biological macro foundations that created the asymmetry of information. Otherwise, they will have to compete on volume, but that will be very difficult. Why? Because Peter Drucker in 2000, one of the most famous management consultants in the US, said that culture eats strategy for breakfast. But Mark Andreessen in 2011 of Andreessen and Horowitz already said that software is eating the world. He was right, but also wrong, because now we know that platforms are eating the world. Now, platforms are basically going to transform industry, many industries like Uber for the transportation industry, Airbnb for hotels and travel industry. It has not happened yet in banking, even though we see the movement of open banking, again, for some of the reasons I told you before. Now, before I get there, I show you this picture, which has some of the books of platform theory on the left side, and my financial market transparency book on the right side, which is theory of finance that enables you to understand how to build a platform that makes sense for banking, because banking is different compared to other industries because of the biological macro foundations that shape the asymmetry of information I told you before. Basically, an industry can be transformed by platforms with a certain easiness if it is information intensive, right? So because you can filter relevant information, banking is information intensive, media is information intensive. If there are no scalable agents like retailers, right? There are shops, and even in banking, you can replace a branch in many cases with a digital enablement. If it is highly fragmented, which is typically not banking because you're going through a consolidation, if there's an extreme information asymmetry, and we know that the information asymmetry is very high in banking. The problem here though is that, as I mentioned before, this asymmetry is biological, it's not about information, which is the reason why it's difficult to apply platform theory you see on the left of this picture applied to banking theory, which you see on the right of this picture, which I'm trying to address with the financial market transparency theory. Now, the other two impediments to transform successfully banking and finance with platforms is due to strict regulation, which typically makes the platformification exercise very complex. Now, we know that regulation is the way the banking system works. You can think about the GDPR or the MiFID II, and high failure cost. Basically, we can conceive a failure of Facebook, a social media platform, but it is inconceivable for the many to conceive the failure of a bank, because they might trigger the failure of the old banking system. So now, if we have understood this, we understand the problem that we are facing when it comes to the problem of platformization. So now we need to transform with FinTech from transactions to services. See the picture, the image on the left of this graph, and from products to clients. That means we need to bundle banking services, not unbundle, into a different experience, the concept of the financial platform for my financial life. But at the same time, we need to apply open banking and open finance. So we know that banking is becoming more contextualized. So it's moving out of the banking relationship, being inserted inside the ecosystem. So on the right side, you see instead a different graph, which is taken by a re-edition of the book Reinventing the Product, which has two axes. On the X, the system intelligence intensity element, and on the Y-axis, the user experience. So more system intelligence along the X-axis and more user experience among the Y-axis. Traditional banking occupies little system intelligence and little user experience. Digital banking tries already to have more system intelligence, like using the data to optimize marketing, and basically move a little bit from output to outcome, looking at the client journey of clients. But the real transformation in platform economies will come where banks will learn how to build bundled banks, which occupy the best value spaces, so more intelligent engagement and more open ecosystem play, or contextual banking, which is the difference between the two. Bundle banking is the attempt of Goldman Sachs to bundle bank on digital Marcus, ICO, the Apple credit card, the United Capital, where contextual banking is Good Doctors by Ping An, where they started creating a solution for people looking for doctors, and they plugged inside that one an O2O mechanism to sell insurance contracts. Now, only by understanding the biological macro foundations of finance, so the source of the asymmetry of information, I believe that banks will be capable of moving from today exercise on digital banking into the highest quadrant of bundle banking and contextual banking. But that really requires to be human-centric to conclude my presentation today. Abraham Lincoln, US president in the 1862, wrote a letter to the policymakers 1 month before he signed the Declaration of Rights that freed the slaves in the United States of America. He said which is very important, he said that the dogmas of the quiet past are inadequate to restore me present. So he said, as our case is new, so we must think anew and act anew. That's why I told you, the most complex innovation is to change the way we believe the world works, so finance. And this is what transparency, when understood, can create, because transparency is the element on a very asymmetrical platform to generate positive network effects that can transform banking into an ecosystem that generates more value for clients that they're happy to pay for. So transparency is the only mechanism that enables to address the biological asymmetry of information to make sure the platform economy can work also in finance. So what does it mean in the words of Abraham Lincoln? He added in his letter that giving freedom to the slave would have assured freedom to the free. That means if bankers understand that the center of banking and digital is not the client, but is the human being, basically his needs, so they will be able of transforming the business model out of products into client relationships augmented by digital. So basically there is a transformation that we have to do in the fintech ecosystem. Everybody, most of the people have been talking about the fact that we need to create a data-driven bank. And I'm telling you, this is not correct. It is relevant, but there's something more important that needs to come before so that happens. We need to create data-enabled client because we are looking at this one flipped upside down. So we need to change this concept. Only when we'll be able to know how to use data on an open ecosystem transparently to enable clients to be self-directed, they will be capable of operating on digital in a way that they're feeling responsible, and therefore platform economies can also transform banking from outputs to outcome, therefore from product centrality to the centrality of the human being. So I know that we mixed some concepts which are highly theoretical, but I also gave you references to the way this business model might look like. You can all link me on LinkedIn. You see the QR code on this graph. You can find the books. The Financial Market Transparency is the needed theory that helps us to understand the real essence of banking and finance and digital, which is the value created by transparency to reduce the asymmetry of information, to enable people to make more conscious financial decisions facing fundamental uncertainty. Thanks.
Well, thank you, Paolo. That's kind of lecture, starting from the theory of finance to the portfolio management. So thank you for the brief information in such a short time. But I have some questions. You were mentioning about the platforms, the platform economy, and the role of the banks. What kind of platforms do you think that we are going to see after COVID-19 era?
Well, there will definitely be an acceleration of the digital economy because we realized that it is important to stay connected. Now, this acceleration will clearly take two forms. One is about payments to make sure that people can carry on their daily life, even though they might not be capable of accessing cash. Basically, they need to do from distance some transactions. But most of all, every element of digital that will enable to create a better relationship will be important because will enable people to get the right information, the right knowledge to make decisions, right, to stay afloat and not to be too much anxious. So we've been discussing the concept of digitizing knowledge instead of digitizing product. Advisors and bankers know how difficult it is these days to reach out to their clients, to stay relevant. Some of them are very anxious about the fate of financial markets. Learning that is not the product itself which is saving the future of people, but is their capability to relate to finance. So all elements of artificial intelligence and digital enablement that enables people to communicate and to build more knowledge transparently are elements that will be infused into the digital bank of the future.
So, as far as I know, the banks are very strong and they have the capacity to survive. So, what about fintechs after COVID-19? What will change?
Well, this is an acceleration of the problem, I would say, because there's no doubt that we were living in a certain hype period because the liquidity was also booming. I know that not all of the interpreters could access the liquidity, but effectively this was the case. Now, this is accelerating the need of FinTech to collaborate. So we will see more M&A in the FinTech area, not only towards the banks, right? So being both right or acquired, but I think it's important that FinTechs understand how they can get together to be stronger because ultimately, if the platform economy is the one that is capable of transforming an industry from output to outcome. And platform economy makes sense the more value you have on that platform, right? So simple-mindedness is just an initial starting point. It cannot be the end point for a fintech to really succeed in being sustainable and transform. And this will accelerate this process. So I guess that those that will be capable of understanding this will be successful. The others will be unfortunately left behind, which is actually a problem to even the crown of the fintech innovation, if you like, the challenger banks with their fancy evaluations. So they might realize now that playing on volume only will not take them that far, and they did not play on value sufficiently. So in front of uncertainty, you can be volume if you're really volume business, but many of them can be Alibaba, right, or Amazon. So they missed the opportunity instead to create value, which is resilient in a moment where uncertainty is very high and the macroeconomic conditions change very fast, like a negative interest rate, so that their capability of making money is further reduced. And hopefully it's not too late for them because they have some cash on the side, but I hope they will make the right interpretation of this change. But again, if they think that the solution is to digitize a higher margin product or insurance, they will make another mistake because platforms are not about products. Platforms are not about output. They are about outcome, inviting people to pay for outcome. That is the complex thing.
Yes, as we can imagine that payments will going to shine at home right now. So which areas do you think besides payments are going to be very popular within the next few months, let's say?
I think that by all means, the central banks will accelerate their mindset towards the CBDC, the central bank digital currencies, right? So that is why payments will accelerate its transformation mode, not just because people might want to use it, but because centralizing how important it is for them to have a direct mechanism with the economy, like the central bank in China is basically trying to do. Now, that can take different forms. It's not necessarily a crypto, it's not necessarily a blockchain, whatever, but it's definitely a transformation of the way the monetary transmission is central bank, and that cannot only go through digital, which means very interesting and relevant investment in digital infrastructure to facilitate the upcoming future of central bank digital currencies and all of the fintech ecosystem that can go around that to create solutions and value for the final customers or the intermediate institutions that might be able or required to basically interact with the new system. So that definitely is going to be, to me, a key part of the transformation of the fintech ecosystem given the coronavirus crisis.
Okay, I have one last question. I know that you have a very limited time. About fintech startups, to be successful or to survive in the next few months.
Keep tight. Now, I guess that the ecosystem is broad, right? So there are startups that operate in very different areas. We already saw, so the answer cannot be unique. Now, we already saw a transformation in the last 10 years from B2C models towards B2B models, right? And the reason is because, and I explained it in the presentation, the asymmetry of information that generates revenues in banking and finance is not about information that digital, can play with, but it's about the biology of people. That means it's linked to mechanisms which are very expensive, where banks, notwithstanding their cost income that is problematic, are still excelling with, right? Now, the problem with the B2B is that banks themselves have a harder time of onboarding innovation. Most of the time, innovation centers were innovation theater, to mention the innovation book of my friend Richard Tarin. And the current crisis might create even more trouble. When I, first of all, conceived my startup, that was an entrepreneurship exercise inside the bank when I was a banker, I proposed the idea to the CEO. I said, why don't we expose our engines and capabilities with APIs so that other players can access them? It was 2004 to create new solutions. He originally said yes, but then when the bank started merging with another bank, said, Paolo, integration, no innovation. So now I guess that the integration effort of banks will have to continue and accelerate because the regulators might try to create a more if you like, concentrated marketplaces, because some banks will be troubled, which will further create problems to the fintech in terms of accessing. Why in the next 3-4 months, I think that it will be very important for them to be very open about the future, contradict their hypotheses in the business model, and look around across entrepreneurs if they can strike deals entrepreneur to entrepreneur, because they might find it even harder going forward to deal with banks. But if that gives them the opportunity to, revise their assumptions, mold their business model, they may be able to make it happen. You see, banking is a very interesting industry. Is centuries which are difficult to break. The legacy leadership is very strong, but fintech entrepreneurs can be very stubborn as well, right? And this is not the time to be stubborn at all.
Thank you very much for this fruitful information. That was fantastic to chat with you also. I think we can both use this session at our lectures, in the future, because it was full of information. Okay, I hope to see you live in Istanbul next time. Thank you for your time and energy that you're sharing with us.
Absolutely. So I hope that the world will improve from the health perspective anytime soon, so we'll be able to travel and meet in person again. In the meantime, stay safe.
And you also. Okay, everyone. This is the end of FinTech Istanbul's digital meetup series. So see you next time in our meetups. Stay well and stay safe. Goodbye.